The second thing that kills retirement is sickness. And there's usually 3 types of sicknesses that kill our retirement. Either medical, disability, or long-term care. With medical, they're saying right now 65% of all bankruptcies are contributed to medical expenses and bills. Think about without the proper amount of health care, imagine what happens when you go to the hospital. If you walk across the street right now and get hit by a car, how much is just the ambulance to pick you up and take you to the hospital? Right? Second thing that kills is disability. They say when our working years, 1 out of 4 of us is going to be disabled for 90 days or more while we're disabled. And a lot of times we think that Social Security is going to take place and fix this. But oftentimes, over 65% of the time when we apply for Social Security disability, we're declined that. So the first time you apply because you're sick, they decline you. But at the same time, all your bills are flowing and flowing and flowing. And while most of us think that disability is caused by us walking across the street and getting hit, 42.1% of the time, it's coming from skeletal and tissue disorder, and cancer causes it 42% of the time. How many of us know somebody who had lung cancer? Right? How many of us know somebody has breast cancer? They go through chemo. Even with chemo, if you had somebody like that, they're sick and they're tired. And then do you think after you go through chemo every day, do you really want to work to generate an income for yourself and for your expenses? So we have to make sure that we have the proper amount of disability, health care, medical insurance, and long-term care insurance just in case whenever we get sick in life. We have to think about retirement is inflation. Inflation is one of the biggest killer and erosions of money. Because no matter what, goods and costs and stuff is always going up. Coffee went up this year, gas went up this year, healthcare went up. But it's your investments that you have and your saving instrument isn't keeping up with the same price of the cost of goods. If not, that dollar you have is going to be eroded. So what you need to do when you retire is you need to make sure that you do not lose the purchasing power of your money during retirement. Or while you're saving. So oftentimes what happens is if we don't do that, we don't keep up with inflation, we're losing the value of our dollar. And one of the biggest mistakes that we have for retirement planning is putting our money into savings accounts, CDs, and money markets. Right now we're at historical lows for our savings rates within our banks. And right now the Federal Reserve said they're not going to raise rates for another until 2014 at least. So with that, people need to find instruments and vehicles that's going to give them a higher rate of return than keeping all their money, even though the bank is very safe, but give them a higher rate of return so they can make sure that their money can keep up with inflation. So when we do retire, we do get older, we can still buy coffee every day at Starbucks or pizza. I prefer pizza myself. We can still go gas, we can see our grandkids, our family, and we can still travel the way we want to. And the fourth thing that kills retirement is being way too risky. Now think about this. If you had all your money in the stock market on October 12, 2007, the day before the market crashed, you still have not broke even with the Dow Jones average yet. So that means if you were about to retire, say you was about to retire, you was age of 64, you say I'm about to retire December 1st of 2007, and then the market crashed and your money went down, you're probably still working to this day. If you still have the same job, God bless you, because remember at that time, there's tons of layoffs and everything else. So the key to investing is knowing how much risk you are able to make. Because being too risky in retirement, right before you retire, it can be a hazard. Imagine if the next market crashes. Do you want to be in that situation? Well, if you just balance your portfolio out where you have some assets that are safe, that are a little bit safer, they can give you a pretty good rate of return, but having some a little bit more aggressive, not all of it, you might just be okay for your retirement planning. Instead of being in a vehicle where you're just being way too aggressive towards retirement planning.